Finishing today. Are you pleased about that? You can see I've got your packs of past exam papers there for us to start working through next week. So the last section of work is the section of work that is called sensitivity analysis, but it starts with CVP. And if you remember CVP from second year, it's sales.
This is a demonstration of
less
Wirecast.
Variable costs, which gives you contribution, or I think in second year we called it marginal income. Less fixed costs gives you profit. That's your contribution sort of table. And we looked at various ratios, etc. in second year, but the most important of those ratios was break-even, where break-even is fixed costs over contribution per unit. These top three are all variable, so those ones we look at are per unit. Sales price per unit, variable costs per unit, contribution per unit. This is all variable costs, production and non-production costs. And then at the bottom we have fixed costs, and fixed costs are total rands, because fixed costs don't change with volume, and when we look at fixed costs we look at them as a total rand amount. So break-even is fixed costs over contribution per unit, or break-even in rands. Sometimes you don't get given units information in a question and you have to use break-even in rands, is fixed costs over contribution margin or contribution ratio. And this contribution ratio is contribution over
is a demonstration
sales.
Of Wirecast.
It's the percentage of, it's like a gross profit percentage, isn't it? Or gross margin. Contribution ratio, contribution margin, sometimes it's called. And that will give you break-even in rands. We also, when we did CVP, looked at margin of safety. And margin of safety is a ratio that tells you how well you can sleep at night. It tells you how much your actual sales is bigger than your budgeted, or sorry, your break-even sales divided by break-even sales. Actual minus break-even divided by, sorry, now I can't remember. Margin of safety, yeah. Actual minus break-even over, I'm sure it's over break-even. So it gives you a percentage of how much your actual sales is greater than break-even sales, right? It's a percentage. But at third year level, I'm not sure if you would be asked these really come from second year, isn't it? You remember them doing them in second year. At third year level, when we're looking at CVP, we really are looking at two things. We're looking at multi-product break-even, which I taught you when we were doing the assignment, because it needed to be done.
Wirecast.
And we're also looking at sensitivity analysis. Sensitivity analysis, how products, or how our CVP is sensitive to movements in profit, etc. When we look at multi-product, the important thing here is that fixed costs are for the company as a whole. Fixed costs, as management accountants, we do not split fixed costs among products, isn't it?
Wirecast.
The only fixed costs that are sometimes split among products are production costs. They are split for absorption costing because of IFRS rules, isn't it? Accounting rules. As management accountants, fixed costs, we don't split among the products. They are for the company as a whole. So in order to do our break-even, if our break-even is fixed costs over contribution per unit, what we have to do is we have to work out contribution per unit for the company as a whole. And we have to do that by using the weightings. Do you remember we did it, the calculation when we were doing we did the calculation when we were doing the assignment. So I'm going to take you through a calculation, and then a little bit later today, we're going to look at an example. So the actually should move this up.
This is a
So
demonstration
I'm looking in
of
your Drury
Wirecast.
book at page 311. Sorry, not your Drury book, your study guide at page 311.
This is a demonstration of Wirecast.
So on page 311, you'll see it says XYZ has two products. The products are product X and Y, and they've given you the contribution for each of the products, 7 and 8. Then they've told you that there are fixed costs that they have apportioned. They will sometimes give them to you like that, but now remember, this apportioning of fixed costs is just arbitrary, isn't it? Depending what basis you decided, if you decided units, if you decided labor, if you decided machine hours, if you decided activity-based costing, isn't it? This apportionment can change. So we're not really wanting to work with this apportionment in management accounting. So what we're going to say is we're going to say fixed costs is 300,000. And then I need to divide that by contribution per unit, which needs to be the weighted average contribution, or the contribution for the company as a whole, isn't it? So this calculation then for contribution for the company as a whole, we need to do, and there are two ways of doing it. I like to do it this way. I like to say, product A is 70,000. It's 4 Rand for every unit, 4 Rand contribution for every unit. 7 4s are 280. Product B is 30,000, and there are 8 Rand contribution for every unit. That's 240. So then I land up with a total contribution of 520. And I divide then by 100,000 units, and I land up with a contribution per unit of 5 Rand 20, which is the average contribution for the company as a whole. Yeah? You remember doing this when we did the assignment. So that's the way that I like to do it. You can also do it by just using weightings. So what you can do is you can do this. You can say there are 100,000 units altogether. My product A, which is 4 Rand, weights 70 over 100. Yeah, 70% of my units are product A. And product B, which is 8 Rand, weights 30 over 100. And all I've done is use these numbers. 70, 30, 100. If you do that calc, 70% of 4 is 2 Rand 80, and 30% is 2 Rand 40. You get 5 Rand 20. So that's also an easy way to do it. I just happen to prefer to do it the blue way. But you can do it either way, the blue way or the purple way, as long as you land up with a contribution per unit for the company as a whole. For the company as a whole. So that's your first step then. The calculation here would be 300,000 divided by 5 Rand 20. And we would get contribution. And that contribution that we get, if you look on the next page, it's there, is for the company as a whole. Here it is. 300,000 Rand divided by 5 Rand 20. But now what we have to do is we have to say, okay, this is for the company as a whole. I still need to know how many of each product I need to make, because I don't make for the company as a whole. I make 2 products, X and Y. So you then have to take it and split it back to X and Y. So I have to take these units and I have to split them into X and Y.
This
And the
is a
way that I split
demonstration
them
of
is according to
Wirecast.
the sales mix that I'm given, isn't it? What is the sales mix I was given? 70 over 100 and 30 over 100. That was the sales mix I was given from the budget. So then I take the 57692 and I say 70%, 30%, and then you land up with answers that they don't give you, is it? Yeah, looks like they don't. But that's the,
This
so let's
is a
work that out then
demonstration
for
of
ourselves.
Wirecast.
If they asked you for the break even, you would have to give it, I think, by product. 692. So it's 4385 if I round off. If I round up, rather, I want to always round up. And 17308 if I round up. Okay. So
This
that
is a
is
demonstration of Wirecast.
multi-product break-even. Yeah. And like I said, later on we're going to do a question from assignment 3, and that question includes an example of this for you guys to practice by yourselves. Don't add up? Out by a rand? Yeah. It's because I've rounded both of them up. So this one rounded to 4.2 or something like that, and that one rounded to, and then I rounded up, because if you do 4, you won't break even. You'll
This
have to do
is a
4 point something, so
demonstration
you
of
have to do 5.
Wirecast.
So that's all. I think probably here already it didn't round. What was the answer there? If you take 300 divided by 5.2. Yeah, there was a 0.3 units or 0.3 units there that was missing as well. So here they should have rounded this one up to 3 as well. Because if you do 2, you won't break even. You'll be a little bit short, because the break even is 57,692,
This is a demonstration of
30,
Wirecast.
0.30. So that 0.3, I would always round up, because if you do 52, you'll have a small loss. Yeah. So you're always going to have either a small loss or a small gain because of the point units, because you can't do a point unit. So we don't want a loss, so we will always just have a small gain. I think if you remember when we did the one assignment, we also were looking to see if we would break even, and we landed up with a 200 Rand profit. Do you remember? Because of the fact that you can't make point something of a unit. Okay.
This is a demonstration of Wirecast.
Now it adds up, right? You happy now? It adds up to all right. Okay, so I said to you that it's about multi-product. So multi-product is fixed cost over contribution per unit for the company as a whole. So there's a little bit of a calculation to do that company as a whole. And then once you get that, your answer will be break even for the company as a whole. And then you need to take that company as a whole number, and you need to then split it between the two products,
is a demonstration of
product
Wirecast.
A and product B, and you split it according to the mix, per the mix that's given in the question. And one of the assumptions of multi-product break-even is that the sales mix will stay the same. Whatever sales mix you've budgeted, 70, 30, 20, 80, whatever it is going to stay the same, right? If you think that your sales mix is going to change, then you need to change your contribution and start changing up there already, isn't it? If you think it's not going to stay the
This is
same.
a demonstration
Okay,
of
then
Wirecast.
sensitivity analysis. We did a little bit of sensitivity analysis, I think, in that assignment 2. Because the way sensitivity analysis works is this: if this is my formula, sales less variable cost is contribution, less fixed cost is profit. The way sensitivity analysis works is that they say to you, I want to have a certain profit. Right? I want to have a certain profit. If I want to have this profit, what should my selling price be? Remember that we had that question in the assignment, isn't it? Or they'll say to you, how much increase can I have in fixed costs and still break even? Yeah, or they can say to you, how much could sales volume drop and I still break even? That's what sensitivity analysis is. It's an analysis of how much can my prices increase or decrease, my costs increase or decrease, my volumes increase or decrease. So sensitivity analysis is all about volumes changing,
This is a demonstration
prices
of Wirecast.
changing, costs changing. How much can those change? And I still break even. That's what sensitivity analysis is. So it's about all of these changing, but still break even. And so there's an example that I want you to practice there. It is example, it's activity 14.9.
This is a demonstration
Which
of
is
Wirecast.
on page 305. 305. Okay, so this is what I want you to practice doing today, a little bit of. The following information relates to two-lead trades. So if I do a CVP thing, it's 15,000 units. I like to put the units at the top. And then it's 100 Rand selling price, 30 Rand variable cost, 70 Rand contribution, and fixed costs, 800,000 Rand. So that's number of units, selling price, variable cost, contribution, fixed costs. Yeah. So whenever we do a management accounting costing question, this is what I want to get to always, isn't it? I want to get to a picture where I can see what volume is, what selling price, variable costs contribution is, and what fixed costs is. So now it says use a spreadsheet, but you're not going to use a spreadsheet because we don't have a spreadsheet. But in practice, you would use spreadsheets, which is why in your handout you'll see there's something called IT and CVP, which is the whole thing of performing scenario analysis or sensitivity analysis. It says calculate the current profit. So if they sell 15,000 units, what current profit are they making? Calculate the profit if 18,000 units are sold. Calculate the profit if the selling price decreases to 90,000 Rand. And then it says for number 2 and number 3, calculate the sensitivity of the profit change, of the profit to change in the scenario. What is the sensitivity? In other words, the percentages. When we're looking at sensitivity, we're looking at percentages. It's asking you what is the percentages of the change. What happens to profit when we change to 18? What happens to profit when selling price reduces to 90? Yeah. So that's an example of a sensitivity question. So I'm going to let you do that while I quickly just go get copies of assignment 3, which I've printed downstairs. Okay, let's have a look. Next page. All right, so they did it in Excel. I'm sure you can see in your study guide. They start off with the profit for the number of units it is now. When you're doing it in practice,
This is a demonstration
I would work out a
Wirecast.
contribution first. I would just times that by the 15 and start there. Yeah, don't waste time doing each line. Then take off the profit, you land on 250. So current profit is 250. If we sold 18,000 units, then, they show you all the formulas. Okay, thank you for that. If you do 18,000 units, then we've got 18 at 70
This is a
less that, which
demonstration
gives
of
us
Wirecast.
460%. Then what they did is they looked at the percentage change, isn't it? That's what sensitivity is, percentage change. So the percentage change when I increased units was 84% change. They then worked with a change in selling price. So when we changed selling price, this number changes. So when I change selling price, the number of units stays the same, contribution changes, and I now have less profit, isn't it? And you'll see that that sensitivity or that percentage change is the 60. So that's all that sensitivity is. It's looking at various scenarios, whatever scenarios they give you. We had one in the exam. And then if they ask you to work out the sensitivity, you give it as a percentage change. So changing volume from 15 to 18 increased sales by, what was the percentage we had? 84%. Increasing price or decreasing price from 100 Rand to 90 Rand had a sensitivity of 60%, changed profit by 60%. Yeah. The problem with sensitivity, and that's why in your paper you'll see that it talks about IT and CVP, is that sensitivity, if we're doing it manually especially, is dependent on one variable changing at a time. We're not computers, isn't it? And what we know is that in practice, if I reduce price, it should have had an impact on volume. Do you agree? So this should have had an impact there. So we should have seen a double impact. And that's where in practice we can use computers to do sensitivity analysis, and it's much easier on a computer to just keep changing variables and running the same numbers, isn't it? And I'm sure that you all in practice have done that to some extent or a lot of extent.
This is a demonstration.
All right, so that's CVP and how we will see CVP in exam questions. Then I want to just touch on something that we also did in the assignments, I think in a different place, operating leverage. Because this is where operating leverage fits, and if you're looking for operating leverage, this is the chapter that it's in. Operating leverage is a formula that looks at contribution and divides it by profit. And I think we've had this discussion, so I'm not going to go into a lot of detail. All I want to remind you of is that contribution is before fixed costs and profit is after fixed costs. And that's why this formula is called leverage, because it's all about fixed costs. It's about what is the extent of fixed costs in my business, and if I have, and the link between fixed costs and variable costs, because there's a relationship between these two in a business. When I start off a business, I am very manual, my processes are very labor intensive, and so my costs tend to be variable in nature, isn't it? I rent a car or a delivery truck, or I outsource that to somebody else. It's all variable. As my business grows, so then my variable costs become fixed costs. I employ people. I buy my own trucks, isn't it? I buy machines, and I become automated instead of labor intensive, and so I then have variable fixed costs. The more that you convert those into those, the more leverage you have. Yeah? So the higher your fixed costs, the more leverage we have. What does that mean? That means that I'm making my variable costs fixed. When this happens, contribution goes up, isn't it? Because contribution is sales less variable costs. And that means that if I sell more units, I'm going to make more profit, because fixed costs don't change with units, isn't it? So that's what operating leverage is. It gives you an idea of, if I increase volume, how much is it going to give me in profit? Because a company that has low leverage, that has low fixed costs, their contribution is small. So selling a lot more is only going to increase profit by a little bit, because contribution is small, isn't it? So it's something that happens along a product or a business life cycle. When a business first starts, your aim is to just break even, isn't it? I want to know how much I need to sell to break even. Then once you've achieved break even and are comfortably doing well, your next step in your business is growth, isn't it? And to get to that next step, or the next place we want to be, is we want to know, okay, when should I start renting premises? When should I start buying trucks? When should I start buying machines, isn't it? When should I start moving from being labor intensive and having lots of variable costs to taking more risk? Because you agree it's more risk. Converting myself to be more fixed costs, but what that does is it gives you that potential to be more profitable, but only if you grow. If you don't grow, then not. Okay, so that's operating leverage.
Are there some businesses where you tend to find that you have more variable costs than fixed costs?
Are there some businesses?
Yeah.
Only very small businesses, I would say, like startup businesses. Companies that would almost outsource a lot of
This is a
their,
demonstration
work.
of Wirecast.
I don't know. Yes, it would be if your staff is more like temporary in nature. Like I'm thinking of my sister's business. My sister's an architect. She runs her own practice. So there was a stage where whenever she had extra work, she would outsource it. So if she had a lot of extra work or had a lot of design work to do, there was somebody that she knew. She has friends obviously that she worked with, and they sort of shared work between them. If one's got a lot of work, they share work between them. And then at one point in her business, so that's all variable. Hey, all her costs are variable. If she doesn't have a lot of work, she's not paying anybody because, then she got to a point in her business where she decided, no, she needs to employ some people full time. Then those become fixed, isn't it? Because now, regardless whether she has a lot of work that month, she has to pay that person. But what she's paying that person that she's got as fixed is less on a per unit basis than somebody that she pays outsourced, isn't it? Or that she has to share profits with or income with. So it comes with risk, but if her business carries on growing, it means that extra profit is hers in her pocket. Do you understand? So I think it's more businesses that are small. Also because we've got this dilemma that we treat labor as a variable cost when it's not really. But it sometimes is, isn't it? If it's outsourced, if it's temporary labor, then it is variable. But if it's somebody that you've employed, then it's fixed. It's fixed at least in the short to medium term, isn't it? Because you can retrench people, I guess, but it's not a nice thing and it's not an easy thing to do, to retrench. And it's expensive. Yeah, you have to pay packages and So there is always an element of variable and fixed. As businesses grow bigger, that swing to fixed grows. And in some businesses, there's very little variable. So in service type industries, banking, insurance, very little variable cost really that you can say. It's just a big bank of overheads. And then you spend a lot of time, right? Within those organizations, they spend a lot of time figuring out how to allocate these overheads in a fair way, but also in a way that would result in a good measurement of performance of the different businesses or divisions in the group.
I was thinking because I make cupcakes and I'm thinking, what can I convert to fixed costs?
Yes, you see, because you're a small business. But imagine that you grow into like a big bakery, right? You're going to employ people. That's fixed. You're going to buy big ovens. That's fixed. You're going to get your own premises. That's fixed. You're going to buy your own delivery trucks. That's fixed. So those all become fixed, isn't it? Whereas at the moment, like you say, it's all variable because
If she makes a minimum order, then her cost will be fixed per minimum order. So if she makes a minimum order of 50, she'll have fixed cost because they'll order in increments of.
if she says to people that they can only order 50 at a time.
Determine the unit, then she's basically dependent on whatever that is. But if she does her costing based on a batch of 50, and if you want to buy it.
This is a demonstration of Wirecast.
It's an interesting thing. But it is, like where you are now in your business is Europe, yeah. Everything is variable and you're just thinking, well, what do I need to charge to break even to cover all my variable costs? I don't have any fixed costs. But you do have fixed costs, you're just not seeing them because your fixed cost is you, right? It's you, it's, it's your, I don't know what, the piece of your house that you use. It's when you drive your car to go and buy ingredients and deliver goods, isn't it? Because you're using up not just fuel, which is variable, but the maintenance and all that, the use of the vehicle. So and we still have yet to see cupcakes. I've heard about the cupcakes, so I'm waiting. I'll wait. All right. Okay, so the next section of work, which is then the last section, is a section of work called sensitivity, called risk. It's about risk. So if you look at your handout, you'll see that I start the handout on sensitivity with a little thing of CVP assumptions. I then talk about multiple product CVP, Operating leverage, I talk about sensitivity analysis that we can do using computers in practice, and then we're talking about risk at the bottom there. I like to show standard deviation. Yeah, you remember that from first year? No? But I want to show you a picture of what risk is, because when I saw it like this visual, it explained to me exactly what risk was. And maybe I've shown it to you, I don't know. So imagine that you have a business or you have a projection of results that you can get in a business, and the projection of results looks something like this. So this is your results over time, and you know from the work that you've done on standard deviation and expected outcomes, we do a straight line through that, isn't it, to work out what's the expected value, which is sort of the average. So the average would maybe be somewhere along there. Do you agree? Assume the dots are your outcomes, your different outcomes. Yeah. So the dots is your different outcomes over time, and so then you draw a straight line through that. Okay. In practice, sometimes when you see share prices, for example, they will do them as a curve. So they will do them, it will look like this, and they'll go, this is how the share price moved over this time, isn't it? And then you'll draw a line through that and say, okay, it's going like that.
And the line is?
It's your norm, your mean. Okay. So assume that we have a different company. So that's one. Assume we have a different company, and the other company's expected outcomes look like that. Do you agree it's the same blue line? If I have to draw a blue line through, which is an average of those numbers going up and down like that, it's the same line, isn't it? Because if we look at the green, all that's happening is with the green is I'm going like this. And if I look at what's happening with the red, I'm going like this. Do you agree? Okay, so the mean, the middle, is still going through as the blue. Risk measures how much my actual results differ from the average.
A demonstration of Wirecast.
If I have to draw lines of that movement, of that difference, for my greens, these are the little arrows that I would draw. Do you agree? If I have to draw comparative lines for the red, this is the arrows I'm drawing. These arrows is standard deviation. That's what these arrows are. That's how we measure risk. We measure risk by looking at how much my actual results deviate from the norm. If they deviate a lot up and a lot down, it's big risk. If they deviate a little, it's little risk. That's what standard deviation is when you do the calculation on your calculator. That's how the calculator works it out. The calculator takes all your data, works out a norm, which is the expected value.
This is a demonstration of Wirecast.
And then looks at the deviations from the norm. And what it does is when it's working out these deviations from the norm, it squares them so that it removes the pluses and the minuses. Because you can see I've got pluses and minuses in my calc, isn't it? So when you look at the calculation squares the deviation to remove the pluses and the minuses. So if I had to give you a little, very little example
this is a
that I'm
demonstration
going to
of
make
Wirecast.
up, I hope it works. Let's assume that there's a 70% probability that my result will be 100 and a 30% probability that my result will be 20. Yeah? Those are my dots. If I work out my expected value is 70 times 100, which is 70, and 30 times 20. Let me do it on that side. Yeah, no, I can do it here. 70, 30 times 20, which is 6. 76 is my expected value. Do you agree? Yes? If I look at my deviation is from 100 to 76 is a plus 24, Do you agree? If I achieve this scenario, then I will be 24 more than the average. But if I go with this scenario, it'll be minus 56. Do you agree with that? Now, I don't take those two and offset them against each other because both of them are an indication of risk. Both of them are telling me that I'm not going to achieve what I expect to achieve. Do you agree? So what I do next is I square them. So I square them. So I say 56, 24 times 24, and I'll end up with 576. And when I square minus, what happens to the minus? It disappears. So I'll end up 3136. Okay? Now, the next thing I do is I look at the probability. So I say, okay, there's a 70% chance that will happen. Do you agree there's a 70% chance that will happen? 576 times 0.7, 403. And there's a 30% chance that will happen, 941. So what is my deviation? 403 plus 941. 941, 403. 1344. But I had squared over here, isn't it? Squared. So this is squared. This is difference. This is square. This is times percentage probability. And now I'm going to square root it. And when I square root that number, I get 36. My square root sum is on the wrong thing because what I want to do is I want to square root the 1344. So let me do that. 36. So when I look at this investment, there's a possibility that I will get 100 as my return, but there's a 70% possibility of that. And there's a 30% probability that my return will be 20. So my expected outcome is 76. What is the risk? The risk, or the standard deviation, is 36. What does this mean? It means that I could expect an outcome that's anywhere from plus 36 to minus 36. That's what it means, isn't it? So that's the standard deviation. Then there's another formula that you see there. It's called coefficient of variation. Do you see it? Coefficient of variation. Now, this number 36 on its own means nothing. It means something in relation to the 76, isn't it? That's why I said to you, that's what coefficient of variation is. Coefficient of variation then says, okay, hang on. I expect a deviation of 36 on 76. What percentage is that? That's quite high risk, isn't it? 36 of 76 is what? 47%.
This is a demonstration of Wirecast.
So this is an investment with a risk of 47%. And that's risk analysis, isn't it? When you studied it, you studied how to do standard deviations on your calculator and coefficients. I don't want you to do that. In fact, in this module, I don't know. I'm a little bit confused sometimes whether they expect you to know how to do this or not. But it looks like, from what I read, let's just read it again. They expect you to understand it, but not to be able to do it. And they expect you to be able to comment on it. So let's just have a look quickly in your study guide. You see, if you look on page 309, it's actually, I've got it here, page 309. It's here, the previous one, I think. Here. So if here's page 309, sorry, I just want to move things around. That must go up there. You can go there. See, if you look here on page 309, it says,
demonstration of Wirecast.
Note, you do not need to know how to calculate standard deviation or the coefficient of variation. But I have seen them ask you to calculate the coefficient of variation, so anyway. But they give you the numbers, and all you have to do is work out the percentage. But you must be able to interpret them when making decisions regarding uncertain future profits. Calculating the expected value is straightforward, and you should be able to do that. That's when I just take 70% of 100 and 30% of 20. Yeah? That's something that we did even in second year, I think.
This is a demonstration
Standard
of
deviation and
Wirecast.
coefficients of variation are also used in investment portfolio analysis, and you'll learn about these in MAC3702. So, yeah, I was thinking I'm repeating myself because I think I've said this I say it in 3702 also. Yeah. So here's an example of something where you would have to do an analysis. So you see they give you the expected outcome and they give you the standard deviation. Yeah, and then they want you to discuss. So they say management is considering 2 marketing plans. The first marketing plan is TV campaign, advertise on TV. If I advertise on TV, the expected profit or the outcome that I expect is 540, 288. They did that through various probabilities, isn't it? What's the probability that people will like the ad and they will, sometimes you like the ad and you can't remember what it's for, isn't it? That's the best. Those are the best. Don't you like that ad? Yeah, what's it for? Yeah, no, I don't know. So that's a good ad, but it's not good advertising, isn't it? Because that company's getting no benefit. But so that's what you expect the profit to be if there's a TV campaign. And the standard deviation is only 36. It's small. What it means is that your TV campaign will be successful, isn't it? It looks like. And it will be successful whether it is very successful or only a little bit successful. It looks like it will be successful. What is this telling me is that I expect the profit from the TV campaign to be 540,000, and the most that it can vary by is about 37,000. So it can be 37 more or 37 less. Yeah? Flyers. The other option is to stand at the traffic lights and hand out those pieces of paper that I don't like taking them because it just litters my car, isn't it? Then you have to figure out how to throw them away. But sometimes I must say when they wave it at you, you see it and you think, oh, that sounds interesting, and you take one, isn't it? So it depends if it sounds. Oh, yeah, I also sometimes do that. If I feel sorry for them. Yeah, and then you throw it away. But they can also throw it away. Or you can say, just throw it away for me. They'll get in trouble, I guess. I wonder if people actually check the bins, like close by where you ask the guy to stand at the robot to see if...
This is a demonstration of Wirecast.
It took the whole lot that the guy had and took them and put them in his car.
This guy got so upset because no one wanted to take them.
Oh.
He walked away.
But you know what? If you want to do a good deed for somebody, take all their pamphlets. But not if it's the guy's business. If it's the guy's business, he won't want to give you all the pamphlets. But if it's just somebody standing there, I'll take them all. You can take the rest of the day off. But you're not helping that person's business. But anyway, yeah. Anyway, so if you stand at the traffic light, then your expected outcome is 640. But here, their risk is much higher, isn't it? So either people really like it, and then you could actually get 640 plus 54, or people will just throw the papers away and then it'll be minus 154, isn't it? So those are the two. They ask you to do a risk analysis. So I've already started doing it for you, isn't it? Because when they ask you to discuss something, you start off by stating the obvious, state what's there. Yeah? The next step would be to work out, because do you agree my numbers are all different? It would be nice to have percentages, because percentages I can compare, isn't it? So the next step would be to calculate a percentage. So that percentage is called the coefficient of variation. It's the standard deviation divided by the expected outcome, or the mean. So it's the one divided by the other. So what are those percentages? I can see some of you. Is the first one like 7%, something small like that?
Of Wirecast.
6.8, yeah? That's fine. 24? Sure. Okay. So now which one's more risky? Yeah, flyers is definitely more risky, isn't it? So then you would advise management. Now this part of advising management, so the risk analysis is done, isn't it? This is the outcome, this is the standard deviation, this is what it means, this is the coefficient of variation, 6.824. This one is much more risky than that one. You can say it's like 4 times more risky almost, isn't it, than that one? Okay. Then here's the problem bit, which is the bit where you have to advise management, because it really is very dependent on somebody's risk appetite. Do you agree? It's very dependent on the risk appetite. So you might get somebody who is conservative. They'll say, let's go with this one. It's not a bad profit. It's 500,000 Rand. And it's a small risk, isn't it? So we go with that one and it's better. Somebody else might say, no, you know what? This one is like 100,000 Rand more than that, plus the expected the standard deviation is even more. So if I look at the upper, the maximum, hey, if I look at the maximum of this one, it is 640 plus 154, which is 794 is the maximum that I could make there, isn't it? Whereas the minimum is 496 or something like that, isn't it? So somebody might look at it and say, no, you know what, I'm willing to take that chance and rather pick that one and take the higher risk. But it all depends on management's risk appetite. So it says, on the surfaces, it seems that the Flyers campaign is more profitable. However, uncertainty is higher, and we should calculate the coefficient of variation. There we go. And then it says, the range of outcomes for the TV campaign is more closely grouped together. When I drew that picture, hey, the little green dots were like closer together. Smaller standard deviation, because that's what standard deviation means. The coefficient of variation is also smaller. Because the outcome of the TV campaign is less risky, you should recommend it. Okay. I suppose as an advisor, as a consultant, you don't want to advise your clients to take risk. They must make that decision whether to take risk, isn't it? So this is like a cover yourself kind of thing. However, the risk appetite should be taken into account, and a risk-seeking management team might be prepared to take the chance on the campaign. Yeah. I mean, even when I look at it, and I think I'm quite conservative and risk-averse, I probably would go with the Flyers. But if somebody said to me, yeah, I don't know. I don't know if they're comparable even, because if you think about cost, the costs of the two must be totally different to each other. And maybe that's how come that one lands up at a higher profit. Maybe this one makes your business grow more, but because it's so expensive, your net profit is smaller. That one makes your business grow less, but it's cheaper to do, and so your profit is bigger. So maybe you need to also be looking at long term, isn't it? Do we want to rather do something that makes our business grow, because maybe that advertising that we do in the beginning is longer lasting, and it will give you that impetus. Yeah, I don't know, but there's so many things, isn't it? So that's risk. It's okay? All right, so what I have for you now is I have past papers, which I'm going to hand around, and while I do that, I'm going, yeah, we're done.
Because I know that the Greek Orthodox calendar is
All right, so what I just gave you is assignment 3. It's not a submittable assignment. I rushed around this morning trying to find solutions because the solutions are not on my UNISA. Not a submittable
demonstration
assignment.
of Wirecast.
No, I think we're done with the assignment. It's this one that.
Yeah, but they have it for submitting.
Which one? Oh, yes. This one they have for submitting. I have seen that on my UNISA. Hey, somebody showed me. But if you read this assignment, I've printed it for you. It says, the assignment is for self-assessment and should not be submitted for marking. The suggested solution will be made available early in the semester, but it's not on the site. I haven't found it. So I went digging in last year's stuff. So that's the solution that I've got there. It comes off the 2015 that letter, because they gave it out in 2015 as well. The same year. Okay, so we're going to look at question 2. What is this now? Do you want to practice doing weighted expected value? No, there is a question. I forgot that I had that one there. So this question is here, Mr. Naidu. It comes out of your study guide. He wants to invest in a new machine, and this is the probabilities, and they ask you to do the weighted amount and the expected value. But you know how to do that, isn't it? You just multiply by the probabilities, and then that's your expected value. And then they ask you to do the coefficient of variation, which is just the standard deviation divided by the expected value. So assignment, question 2 in this handout that I've given you, assignment 3, is a question for 25 marks, and it deals with CVP and standard deviations and all the stuff that we've been looking at today. So I thought it was a good one for us to practice. Then from next week, if you could bring those past papers, we're going to start working through the 2015 exam.
When is our last class?
The end, yes. We have 3 more. Right? 3 more. It's our 3 revision classes. We're going to do past papers in those 3 revision classes. Yeah.
So then do we have a full day revision somewhere?
There is also a full day, the crash course. It's also somewhere it's on a public holiday or a Sunday. I know all the crash courses are on a public holiday or a Sunday. That's what I've asked. Yes, Heavy. I asked Heavy now when I went downstairs if she's got it ready so I could hand it out. She's busy typing it up. So maybe when you're done, if you pop down and check with her if she's got it yet. But I have agreed days with her, but I can't give them to you because I know we changed some of them and now I don't know what they were. Okay. All right. So this one is a two-part question. Part A for 16 marks is a company called Travel Frenzy. They make suitcases
This is a
and
demonstration of
they...
Wirecast.
You see here that there's some probabilities of this new machine. It looks almost exactly the same as the example that I just went through with you. And the required asks you to calculate the break-in sales volume, the number of units, and then the break-in sales value. Once you've worked out volume, you can just times by price to get value, isn't it? Or you can do the calculation, the break-even calculation for sales value if you like. Then it asks you to calculate the units to be sold to make a 2 million rand profit, and you can ignore tax. So that's a bit of sensitivity, working backwards. Then it asks you to calculate the number of expected suitcases that the new machine will manufacture and advise management whether they should buy this new machine or not. Here's the number of suitcases and the different probabilities. So it's doing like an expected value calc there. And then E asks you to explain the meaning of standard deviation and coefficient of variation. So that's the first one, part A. Then part B asks you to calculate break-even for multiple products. So here, a company called Multique. They sell moisturizers, eye gel and eye cream. And here's the information for the two. And there's common fixed costs. Here's the common fixed costs. And they ask you to calculate break-even units using the standard mix and to calculate the break-even sales value. So this is multiple product break-even. Yeah. So a typical exam question. Probably a bit longer than what would be typical for this section of work, but you just never know in the exam what will come up. Yeah. Okay, so I'm going to leave you to do that. I'd like you to work in pairs or groups. It's always nicer, then you can work with someone. You just took the probabilities. Just the units and the probabilities.
The bottom, the 1.5 divided by the 637.6.
It's break-even in rands. If you did break-even in rands using the formula is fixed costs over contribution margin or contribution ratio, which is contribution over sales. You get a slightly different answer to if you did that.
I got a slightly different to your
This
bottom
is a demonstration of Wirecast.
2588260.
I don't know, just copy that one from the solution. I see the solution has this. Your answer is 200.
I've got it over 0.5796.
It's rounding.
This is a demonstration of Wirecast.
Yeah, I'm only rounding to 3, they round to 4.
This is a demonstration of Wirecast.
Even if you round it, just look at the, you don't get the answer.
Okay, I didn't round. I don't know where they get the answer.
No.
I thought the answer was right, so instead of checking it, I just put it on. Obviously not.
This is a demonstration of Wirecast.
Okay, we're not going to look at part B because I think our time is up. Can you give me something that you can move through, we can look at next time if you've done it. So, part A was just to work out your break-even. You had to just work out the variable costs, and the only trick there was materials purchased versus materials used. And I started off just using the materials used, and then as I read through the question, I saw, oh, okay, shucks.
This is a demonstration of Wirecast.
Gave you a contribution of 637.6 per unit. Fixed costs of 1500 were given. That divided by that 2352 point something. Okay, we rounded up. And then I just times by the 1100 to get this number. But if you use the formula, it would be fixed cost divided by contribution ratio or contribution margin, which is contribution divided by sales. You would have got a slightly different answer. Also because we rounded up here, that's why the answer is
This is a demonstration
different.
of
If you want
Wirecast.
to make a profit of 2 million. Profit of 2 million, I have to cover fixed costs of 1.5, so I have to make a contribution of 3.5. My contribution per unit is 637,600, so therefore I must sell 5490 units. I'll just work backwards. And then for the last bit, you just have to do the leadings, so you just have to multiply those expected numbers by the percentages. And you got a number that was just under the 80,000 units expected.
So answer the notes.
This is a demonstration of Wirecast.
Yeah, I know, but I don't know why. I think it's rounding. We were talking about it earlier, and we came to the conclusion that we think it's rounding. But we couldn't get the answer, isn't it? I mean, I couldn't. You
No,
couldn't.
even on their rounding, it doesn't work out.
So I don't know what it is. That total contribution I need if I want that profit. And then if that's the contribution per unit, that's how many units it makes to.
This is a demonstration of Wirecast.
You should have, I was going to say, you should have started working through this now. You have a long time, isn't it, until June. So, we will start exam revision next week, and I want to at least do the October paper, October 15. Then we can talk if you want to leave one of the weeks till later, to come
In
back
May,
later,
yes.
or at the end of May or beginning of June.
Yeah.
But you can let me know. What did we agree with the
This is a demonstration of Wirecast.
We were going to do it May the 2nd, yeah. So we can also talk about whether we need 1 week to come back. Closer to the exam. And then closer to the exam, what we can do is you can answer questions, or I can just quickly take you through everything again. But that's it's going to be like, hopefully by then you're just going, I know that, yes, I know that, or you're going to say, oh, I know that. There is a crash course. Yeah, like I said, Evie is finalizing that to finalize that this week.
This is a demonstration of Wirecast.
I know you don't like usually giving us. And I don't like coming to do this one.
I'm doing the 2 maps and I'm doing 3 FACs. I'm doing 2, 3, and 4.
Oh, you have to pay extra for them.
2602, I don't think I can. I'm doing 2601.
You pay extra for this
FAC 2601. No, not the map. Sarah does the map. No, I don't think I am doing the 2602. Andreas is doing 2602. But it's not your current lecturer.
This is a demonstration of Wirecast.
You're doing FAC 3702. 3702, I am.
Do you pay extra for this?
Hmm?
Do you pay extra?
I think it's like a nominal amount, 100 rand or something.
Okay.
It's just like an admin administration. Because they have to invoice you, I don't know. I suppose if they didn't have to invoice you, they wouldn't have the admin and they wouldn't have the charges.